Hello guys, welcome back. In this video we are taking a look at Change Healthcare, which is actually trending right now, and you will see that it's up 7.4% in the pre-market. And there's a reason for this. Of course, we can take a look at our stock news module and it will quickly tell us that United Health sees court win in Change Healthcare acquisition case. And if I open up this article here, you will see that a federal judge has ruled against the Justice Department antitrust challenge to United Health Group's 13 billion acquisition of Change Healthcare. It looks like the acquisition is going to go through, and this is happening a lot actually when you are looking at acquisitions of companies. Just because sometimes there's like anti-monopoly rulings from federal judges, and so for this reason, this kind of acquisition could get disrupted and could actually be cancelled altogether. But it looks like in this situation, the acquisition is going to go through. And this is why you're looking at the stock pretty much surging right now, because it looks like we're having a pretty much a positive reaction, of course, from this acquisition. Now, 7.4% right now, and of course, the company has been having a stock price which has barely gone down from its 1 year high, which is of course something that is awesome if you actually think about the fact that a lot of the stock market has been trading downwards. When we're taking a look at healthcare, it can actually do rather well even in situations when the overall market is basically tumbling, just because it's an important sector for people. You do need healthcare regardless of the market conditions, because people need food, they need to live, they need to take their medicine. So even if there is a recession, this is one of our core needs really, and this is why healthcare, generally speaking, does well even in recessionary environments. And this one has been actually growing quite a ton since 2020 as well, when it was actually like $6 or 7 over here. Now, the P ratio of the company is negative, and this means that they are losing money, yet their price to free cash flow is positive and near 20, which is fair. So why is this happening? Like, how can you be having negative net income but positive price to free cash flow over here? We will examine that, of course, in more detail when we take a look at the financial statements, but it's worth noting that the company has also been diluting investors quite a ton since 2020. And as you can understand, dilution started happening as the company stock price was going higher, and it kept climbing. And so, the board was actually diluting more and more, because they understood, of course, they know that the stock price was massively up and quite overpriced for the company, for what the company was. And so they actually issued a lot more shares and got the extra funds, which makes a ton of sense as if you are the board of the company. But as an investor, this is something that you don't like to see, because if you bought back in 2020, now your stock is worth much less. There is like 2 times as much, frankly, and so this is really bad. The company has quite some liabilities as well compared to the free cash flow that they generate. And remember, the free cash flow actually gets derived from pretty much logistical things, accounting tricks, which we will examine, because the earnings were negative. The revenue growth of the company has been growing the revenue quite a lot, and that's nice to see. And especially 2020 was a great year for them since 2021. And net income, though, has been going down, and this is always worrying to see. Now, free cash flow, again, because of the adjustments, is up, and total equity growth is also up because, of course, printing tons of shares, you get a lot of funds. Now, you will see that the margins are negative, of course, because the company is not making money, and they do have quite some debt as well. 1.4 over here. It's a little bit less than what it used to be, but still quite a lot. 1.4 is actually almost 1.5 times their equity, and that's substantial, especially considering the fact that the equity has been growing too. Okay, interesting things to see here, but let's take a little bit of a look here at the financial statements, just to discover what is going on with the free cash flow, of course. Now, the revenue has been growing 196 to 3.4 billion over here, growing very nicely. And in terms of the net income, though, this is still in negative territory. Not too negative, but still in negative territory. Now, the good thing about it is that the EBITDA here is actually getting into more and more positive territory. That is, earnings before interest, taxes, depreciation, amortization is what this means. So basically excludes quite a lot of expenses here to derive the actual profitability of the company without these expenses, though. And so this is sort of like an accounting, I should say, measure that some companies use, especially the ones that are not profitable, because otherwise you're going to be looking at negative net income pretty much every year. And so a lot of companies do use their EBITDA EBITDA to evaluate business, especially when you're looking at non-profitable ones. And again, their EPX and diluted EPS here has been in negative territory. In terms of their balance sheet over here, you will see that their total equity has been growing, about doubling itself pretty much through the years. Total liabilities at 6.6 billion over here, which is quite substantial compared to the total equity that the company has. It's quite a lot of liabilities here and quite a lot of debt as well. And additional operating capital, of course, getting a ton of capital, extra capital from the shares that the company has printed. That's quite a lot, quite substantial too. Now, the big elephant, the elephant in the room, what's going on with the free cash flow? You will see that their net income is in negative territory, the company is losing money, yet their operating cash flow is sitting at 700 million, which is a substantial increase from their net income. So what's going on here? Now, there is a little bit of stock-based compensation, but the big thing here is the depreciation amortization. So what does that mean? An easy way to think about this is that the fact that depreciation, let's just say that you bought something, let's just say that you bought a car, and you bought a car for, let's just say, $25,000 2 years ago, and now the market value of your car is sitting at $15,000. This means that you have lost $10,000, so your car has depreciated $10,000. So this is a loss, and it's a net income loss. So it's actually extracted from net income. It's part of the depreciation. The thing is, you never actually got departed of any cash, so there was no cash transaction there. And so since the operating cash flow is about the cash flow, this needs to be added back to the cash flow, and this is why you are adding back this loss. And so in this case, if you were making a cash flow statement of your own, you would be adding this $10,000 of depreciation, because you never actually spend money on that. You lost that money on the net income, on a net income basis, but you do add it back here since it wasn't a cash expense. And this is why you're looking at an operating cash flow which is much higher than expected compared to the net income. And this can be a big trick here. And you may be looking at the free cash flow now and thinking that the company is making positive free cash flow. But that's not really the case. The company is actually losing money here, and it's only making free cash flow because of the adjustments, the accounting adjustments here. Very important distinction, and this is why it's super important to always evaluate companies based on net income and free cash flow as well. And this is what our tool does. Our stock evaluation tool does that, and this is how it works. You can kind of see that already here. This immediately, just these values here tell you the story. You know that the company's free cash flows are pretty much in negative territory here. And you may be thinking to yourself, if the company is making money, why is this in negative territory? So what you do is you examine this little table, this handy little table here, and you see that the net income that the company generates is negative. Again, very handy over here, and you can very quickly see the overall picture of the company. It's losing money, and the thing is, its free cash flow here is in a positive territory, and you are looking at a very negative value here because of the net income being negative and the free cash flow being very positive and much different and much higher than the net income. This is why the high negative value over here. And so this alone tells you that you are looking at a company that's generating free cash flow through sort of like accounting tricks, which are legal, of course, but you still see that the company is not really making money here. This is very important. And our tool here works in conjunction with the net income, like the free cash flow works in conjunction with net income margin. So for instance, we're using a revenue growth. Let's just say that the company grows tremendously well, like it has been growing. Of course, this was the year that it grew a ton. But let's just say that it normalizes and actually still grows a lot, 15, 20, and 25. Net income margin, again, it's negative right now because the company hasn't been making money. But let's just say that they eventually reach marginal profitability. And now over here, what we're doing with our free cash flow margin, this correlates directly to the net income margin, and this is done on purpose. So when you are saying, let's just say that we're adding 100 here and 100 here and 100 here, this means that we're expecting a 1% free cash flow margin compared to the net income, that is. So this is 1%, 100% of 1% is 1%. And 100% of 3%, that would be 3% of a free cash flow margin compared to the revenue, that is. So 3% would be the free cash flow margin compared to revenue growth. And over here, it would be 5%, 100% of this net income margin over here. And again, this is derived from revenue. So this is done so that free cash flow correlates directly to net income margins over here, the ones that we define. And this is done on purpose because we need to be deriving free cash flow from profitability. Very important. You don't just want to be getting your free cash flow from adjustments, because then the company could still be losing money and you are getting positive free cash flow. very tricky, and it can actually lead you to making wrong decisions here. Now, free cash annual return that we want to be using 13%, and if we hit calculate with these values, you will see that we are still in negative territory, and we have already assumed the profitability which the company hasn't been reaching and doesn't seem to be able to reach soon, at least. And of course, this is why a company of this sort couldn't really be under our radar right now. And also, it's getting like 7% higher today. So this is actually going to be higher. I think let's just take a little bit of a closer look. It's going to be 27 or so when the market opens today. So it's going to be even higher. And this is how you should be analyzing the company in a little bit more detail, just to see whether the profitability is real here, because you may just be looking at the free cash flow and be like, okay, this company is making a ton. Because if you take a look at the free cash flow, let's just say that you are only evaluating the free cash flow and you're looking at the company making 420 million, right? And you're like, okay, the company makes 420 million. I go back and I take a look at their market cap, which is 8 billion. So they're making a ton in terms of free cash flow when you actually compare it to their market cap, which is 20. We have it here. And you're like, okay, this looks interesting. But again, if you dive deeper, you will see that this is because of adjustments and not profitability. And this is why I would definitely stay away from this one, even though it's trendy right now and it's trending because of the the upcoming acquisition. It's probably not a company that it deserves a part in your portfolio, or I should say definitely in my portfolio, because your decision is your decision, of course. But yeah, this is a company that I would myself avoid right now. And again, lots of things that we talked about. Outstanding shares also a big problem here. Profitability, the debt as well is a big issue over here. And so this is a company that I would generally speaking avoid, regardless of the fact that it's trending right now. So thank you for watching. I hope that helped you understand a few things about free cash flow, net income, and how they correlate, in case you were not aware of this, of course. And if you did enjoy and if it did help you a little bit, please leave a like. That helps a ton. And subscribe if you are not already a subscriber. And I'll see you soon. Bye bye for now, guys. See ya.